Hey everyone, this is Craig, the options linebacker. This is the weekend report for Sunday, March 21st. Spring is here and March Madness is in the air. This is a great time of year. So what's going on with the markets? Well, I'm going to continue on the theme that I started last week because I think this is so important. Because markets often kind of take the same path and play the same movie over and over again through the years. It's just that they happened so long ago that nobody takes the time to go back and learn those lessons. So we can see that we've had a very strong move up off the bottom over the past year. Very, very strong rally over the course of the year. But we've seen this movie before. What we saw in 2003 as we came out of that recession is that we had a similar move, not quite as impressive, but a similar move that came up really over the course of about 9 months. And then after that, we had about 2.5 years of what I'll call upwards chop. Now this certainly is an uptrend on a monthly chart, but if you break this down to a daily chart, really we just had very few upward thrusts during this whole period. Most of the time it was chopping sideways and then a quick move up, chop sideways, quick move up, chop sideways, a quick move up. So for the most part, this was a very choppy, flat, sideways area for 2.5 years. And then the rest of that bull market kicked off in about the last year or so of it, straight up. So you can see that the strongest portions of that bull market were off the bottom, as you might expect, choppy in the middle, and very, very strong near the end. The reason for this is related to psychology. As you might imagine, in this bear market that finished near the beginning of 2003, by this time, near the end of 2002, beginning of 2003, the retail public was just then getting comfortable with the idea that the market was going lower and were looking for instruments to take the market short. And everybody, of course, by that time thought that we're going to be down, much, much lower than we were at that time. So in essence, this is when the retail money is wrong. And the smart money stepped in off this triple bottom down here and went long down in this area. So that's one of the reasons why the first leg is so strong, is because there's so many retail people that are wrong in this area, and they all have to cover and they feel that first rise, as well as the fact that this is when the smart money gets in, and sometimes the smart money can be rather big money. When we get to the blue box in the middle, this is sort of in the area where the rally has outgrown the recovery. Certainly by the beginning of 2004, there were still a lot of question marks about the economy back then as to whether or not we could sustain things. The housing market hadn't really taken off yet at that point. And, this is where you get the old question marks about, hey, is this thing going to roll over and go back down and double dip again? Or can we sustain this? And we're getting a lot of the same questions right now, so it should feel familiar to us, which is going to be my last point here. And then finally, as we get near the end of this, all of a sudden everybody decides, hey, this thing is going up, and that's when all the retail money gets on board. And retail always gets in last. And the smart money is only too happy to be able to sell that to them, especially at the top. If we move over to today, after this huge rally that we've seen off of the bottom, it may make sense that we're ready for that blue box area, that consolidation period. And the way that we're going to find that out is really by looking at the weekly chart. The weekly chart is showing potential exhaustion here as we're starting to roll over a little bit. And this is actually wave 5. This is the 5th wave, and the 5th wave is usually the final wave, at least for that first thrust up of that monthly chart. So what we could see is the slope starting to tail down and go a little bit more sideways and get back into that area that we talked about over here, that blue box area. So we could be doing that blue box area up over here over the course of the next couple of years. Okay, so that's the forecast for the next couple of years. So what's going to happen next? Well, I've always been looking at this 1200 area ever since we were down in this area down here, thinking that 1200 was going to be a good first target for this thing to take a pause, and we're not far away. We're only 40 points away from it right now on the S&P, so that's just a few days work these days. Now, how soon is it going to get to that 1200 level? That's where we have to go into the daily chart to look for that. Now, markets are fractal. Now, what I mean by that is that weekly move that we just looked at, now when you take it down a time frame to the daily level, is a lot more granular. So you can see within that weekly move, which looked like one move straight up, it's actually been comprised of a couple of different waves so far. So that's wave 1 up, wave 2 down, and now we've had wave 3 to the upside. And wave 3 is definitely longer than wave 1 has been, so that fits that pattern very nicely. So what we're looking for is perhaps a wave 4 to come along here pretty soon. Wave 4 would look like this as a pullback. So if we do get a pullback, how far down is this going to go? And where might we expect to find support? Now at this point, this is where I just take off the indicators and just look at the price here. And this is why I just look at the price with this chart, and why I have all these lines and trend lines and channels on here, because the chart generally does tend to run within these channels and trend lines. Now we can see that one area of obvious support would be around the 1150 area on the S&P, so it may make sense for the S&P to come back down to this area. However, I don't think it'll just bounce right off at that first stop. I think what we might get is something similar to this, where it thrashes around and in this area for perhaps a week or two and forms a small horizontal box at that area, and then if it wants to break out higher above there, it can, although we haven't seen that work out that way in the past. Generally it's taken a quick dip back down to support to be able to generate enough bearish sentiment to be able to drive this higher. Now the second tool that we can look at to figure out where this might bounce is the Fibonacci retracement. So what I'm going to do is I'm going to go back to the beginning of wave 3, which is that hammer way down there, and draw the fibs up here, and you can see that the 23.6 retracement stops perfectly right at that 1150 level. But the next level below that, the 38.2, is at 1137. We have the 50% retracement at around 1128, and the 60% retracement is right around 1116, 1118 or so. So that's as far as it could retrace back to perhaps the 1120 zone before it does find support. And the first place that it might bounce, which would be the most bullish outcome, would be as if it just bounces here at 1150 before it starts to consolidate and go higher. Now just a quick word on position management. I have an Iron Condor set up on the spiders for the April cycle, and I have a bear call spread up here at the 119, 121 level, and I have a couple of bull put spreads down here. I legged into those and separated them on this particular day right there. So on that hammer candlestick is when we entered these trades, so that's close to a perfect entry on those. Now this call spread is taking heat up there, but we've been hedging this position since this point, so we've certainly dulled the impact and we've taken all the heat out of that particular trade. And if you're interested in how to do that, we're giving a webinar on April 10th on advanced risk management techniques that we use all the time. So that's it for this weekend's video. Thanks for watching. I hope you see you next week. Now before you go, just a couple of messages. We are consistent. We've made a monthly profit 14 of the last 16 months. We're about to go 7 in a row now. So come join us at optionslinebacker.com. And also you can join us at an upcoming live webinar as we go through the tricks and skills of the professional traders as we talk about delta neutral active risk management. That's Saturday, April 10th from 9 to 12 Eastern Time. $79 early bird rate. Go to the webinars tab on the optionslinebacker.com homepage for more information. And while you're there, don't forget your free report, the Iron Condor, your retirement answer. Just go to the free stuff tab. It's free. Just need your email address. See you next week, folks. Take care.